this. So hello, everybody, and welcome to today's Monday morning mortgage message and rate update. Christy, do you have any updates for us this morning?
I do. I have a few. For the rest of the week, those of you who might need a headshot or have a dog, we're doing pics with pups or just a typical headshot. We only have, I believe it's one opening left. So if you guys need one, it's tomorrow from 10 to 12. Get a hold of Angie or I, and we'll give you that time slot and let you know more details about it. Like I said, I think we only have one spot open. We also have our pickleball coaching lesson this week. It's Tuesday from 5 to 6 at the JW Marriott. We do have a couple spots open for that one, so let me know. It's for complete beginners, so you don't have to know anything about pickleball. We have a coach that comes in and teaches you how to play. So if you want to play, let me know, and I'll sign you up for that. Also, too, this week, SAR, Young Professionals Network, YPN, is hosting an architecture tour. It's from 5 to 7 it's from 5 to 7 on Thursday, sorry. 5 to 7 on Thursday. You do have to register. It's $50 a ticket, but that includes food truck and your drinks, which are, I believe they're having margaritas and beer. So that their ticket price includes the architect of the homes will be there to do a presentation and answer any questions as well. So that's going to be pretty fun. That's Thursday from 5 to 7. You do need the link to sign up for that. And then also, Angie, Pioneer Title is hosting their Tina Tambor this Thursday. If you need that link, I can get it for you. Or if you know Angie, she can go ahead and just get it for you if you email her or text her, or she can get that to you. But that is this Thursday. So I believe that's it for this week. That's it. Angie, do you have anything else you might want to add?
No, you covered it. We've got, nope, that was everything for this week, Christy.
Perfect. All right. Thank you. Thanks, guys.
All right, perfect. Well, I'm going to go ahead and just get right into it today. And we're going to be talking about what the WTF, what the Fed, what are the Feds doing, and how it's relating to kind of where we're at in this market and what we can expect. So I'm just going to jump right in and go ahead and get started and kind of share with you a little bit about what the Fed. So here's Mr. Powell. He's our lone warrior out there that's taking the heat for everything that the Fed is doing. And it's interesting because I think he's in a really tough position. First off, they didn't act soon enough, and now they're behind the 8 ball and they're going really hard. And this is a global issue now, but what they stated last week was they're going to stay higher for longer. And I know Snoop Dogg would really like that. So that's why I stuck Snoop Dogg in there. But higher for longer, meaning they're going to keep the Fed funds rate as high as possible for as long as possible for really the higher rate environment to make a big impact on the economy. Now, what they're trying to see, they want to see unemployment numbers higher. The problem with that, though, is that the amount of skilled workers out there for the jobs available, is less and less and less and less. So the availability and the amount of jobs needed never really truly gets fulfilled. So we see really high numbers of jobs available and unemployment numbers staying really low. So the Feds have a really hard task ahead of them. I don't think it's a normal type of a market as far as how we're gauging what unemployment is, but we'll see what they do. This next slide is really interesting. Actually, there's one before that, but this is what the Fed, the International Monetary Fund, has said. And now this is global, guys. This is not just the United States. Everything is so interconnected with how each country sells and buys bonds on the International Monetary Fund or in the international markets, that the IMF is saying that their higher for longer rate is squeezing more and more borrowers, right? We all know that. But the world's central banks have unleashed the steepest series of interest rate increases in decades during this 2-year drive to tame inflation, and they may not be done yet. This is the IMF talking about this. So looks like this month the Fed's not going to do any raising or the next meeting, but I believe they may have more in store for us, which I don't agree with. And I'm going to show you something real fast that's going to really shed some light on how the Fed works and what happens following a really rapid rise in the Fed funds rate. Now, this is the chart with the Fed funds rate and how they've raised it and lowered it and what happens afterwards. The gray is a recession. Okay, these gray vertical are recessions. So let's look at this real fast. Let's go all the way back to the 40s, okay, or the 50s. So we had the Fed raised. And then when they got to the peak, they ended up cutting interest rates very rapidly. And then they raised, and there was a recession in the middle of that. But the recession didn't start until it was at the peak. I want you to really pay close attention to that. It started at the peak of this little valley. Then they cut the interest rates very quickly, and then they end up raising them again, and then they cut quickly, then they raised them again. They cut a little bit, but then they raised them again. Then we had a recession. They cut quickly, raised again, recession, cut quickly. So notice that trend. Really fast rise, recession, cut quickly, rise here. They didn't have any recessions here, but they cut quickly, rise rapidly, cut, and then the recession, and then they cut quickly. Then we had this dip, but notice that it rises, then they cut quickly during a recession. So at the end of every spike in the rising of the Fed funds rate, there's always a really big cut and a recession. Now we've had the steepest increase in the Fed funds rate ever for the last couple of years. So notice that steep. Now, what do you think is going to happen with the steep? We're going to plateau off, and then most likely there's going to be a recession and a cutting of interest rates. So that's good. That's a good thing for rates. Bad for the economy, but that's what the Feds want. They want to break the markets. So having seen this kind of this really good pattern, I say really good pattern because you can really predict it easily. We know that the Feds are going to have to cut eventually. So this higher for longer statement has never happened. I mean, kind of in the 90s here, it did a little bit, but this is because the internet came out, and the internet changed the whole world on how we do economics, on how we consume, and it kept it really steady for a while, but never has it been steady before. So there's nothing really coming out now other than AI, which is going to have a short burst of what's happening with our markets as far as the internet and kind of technology, but there's nothing that to sustain a higher for longer strategy. So I'm really confused to see how long this higher for longer strategy is going to be before they have to start cutting. But that's a really interesting display there. So here is what's happening with the bond markets. And I don't know if you guys remember last week, but we were hoping that we would get some sort of break. And when I say break, we some sort of a relief in the fact that the Fannie Mae 30-year bond, and this coupon, this is the 6.5 coupon, it just continues its trajectory lower. We saw a little bit of a rebound here. That was a very good week for us. It kind of went all the way down here, and then we had one day where it kind of rebounded. We thought maybe we would get back into the averages here, which are these lines right here. But we bounced off the 25-day moving average, and then we had a free fall last week, guys. Last week was not good. Every day I woke up, and then Friday we did see some relief after we bounced off this lower Fibonacci level. It seems like this is a pretty strong floor for us. So we are seeing a little bit of relief today. So let's hope this continues. The 10-year is what we're really afraid of. And whoop, did I skip the 10-year? I skipped the 10-year. The 10-year bounced off 5% today, guys. That's a key level. We do not want it going above 5%. We don't. Now, bonds at 5% are very attractive, so maybe that'll bring investors into the bond market because we have just way too many bonds. So in an uncertain environment, we may see more people flock to a secure yield. So you and I could go buy a bond today at 5% yield and have it for a long-term, 10-year yield at 5%. That's not a bad investment if we know we're going into some tougher times. Maybe the stock market will be hit. So maybe people will flood from the stock market to the bonds and really help us out here. So I'm hoping we are at somewhat of a threshold where we're going to start to see some relief. But look at what happened this morning. This is the actual movement of mortgage interest rate yields today. Now, when I woke up this morning, I got sick to my stomach again because we were negative 60 basis points or negative in the 50s this morning. This is how fast the markets move, guys. basically this morning, rates you would have to have paid 0.55 points more to get a rate today because that's what we lost. So if a rate was 8.25 with no points on Friday, today we woke up and that same rate now costs 0.55 discount points more based on this chart. But then we made a lot of ground. We gave that we gained a lot of ground, and now we're positive 15. So we're like 70 basis points better than this morning. That is a big swing, guys. This is why when borrowers are shopping rates, they're out of their mind because everyone's so different at different times of the day and different from one day to the next. They may get these crazy different variances in people's quotes. And it's because it's so volatile on just an hourly and a daily cycle. So it's important to stick with a lender you trust to get through this and really navigate when to lock, because it is very, very volatile. This is the 10-year, sorry. So the 10-year, if you look at it right here, we bounced off that Fibonacci level right here. This was last week. We wanted to stay below this little yield right here. And I said, guys, if we go above this, we're going to go all the way to the top. And that's exactly what happened. So that was bad news last week. We bounced off of it today. We're coming back down. Let's hope we can get back into reality here. So rates are not pretty. There's nothing we can do about it. But we have to live with it. And we need to figure out ways of really navigating this market. But let's kind of see where interest rates are now. This is the national average based on Google's assessment of all of the lenders out there. I found this to be the most accurate with pricing with no points. Now you can get much lower than this. This is the average, 8.32, 7.6 on a 15-year. I mean, how many of you have seen rates in the 8s? It was 1999, 2000, the last time we saw this. So it's been over 23 years. Buyers aren't expecting this. But if anyone saw my little Instagram video about assumable mortgages, we'll get into that in a bit. That's going to be, I think, for your buyers, something to really look into. But let's talk about what happens at the end of the year. What happens with the price of homes towards the end of every year and listings at the end of every year? We have a pretty predictable cycle. And if you look all the way back, this is the July 16th, beginning of the year, we have the cycle of median going up and then down and then up and then down towards the holiday season, Halloween through Christmas. We see the median price lower. Now that doesn't mean prices drop. The median list price takes all of the properties that are listed and whatever the middle number is. So if you have a lot more homes being listed in the 300 versus the 3 million, the median list price will drop because there's more of the lower price homes being listed. That doesn't mean value goes down. So when you ever hear median list price or median sales price, it just means that more of that price range is selling than others. Or there's more of that price range in the market than others. It does not mean that prices are falling. So I know Tina Tambor tries to explain this too. And this is what the media always uses as median. So it makes it look like values are dropping. They aren't. So when your customers say, I see that this month or this season that prices are coming down, they're seeing the median list price come down because it does every year during this time of the year. And the number of listings drop every year during this time of the year. And here's that chart. It's like the ridge of a dinosaur. It's higher during the beginning and number of listings drop and then they go higher during the spring season and the summer, and then they come down and then they go higher and then they come down. And then we have the good old fashioned COVID that just messed everything up. Inventory just went down straight for a whole year. And then lo and behold, it went up and down and then up and down. And it's going up right now, but what do you think it's going to do after the January comes? The amount of listings will then go down again. It's a cycle, happens every time. So we really need to watch what it does as we enter into the spring season with rates the way they are. Because if inventory continues to climb, that's when we could see some reduction in prices. So we want to really watch the amount of listings that are coming up. But this is a really interesting graph to really show your customers as how this cycles during the holiday season with the inventory. Inventory always goes up during the winter time, and because there's not as many buyers looking to move during the holidays. So what's happening this week? Here's the calendar. Really, the most important pieces that we have are Friday. Thursday, we have some jobs numbers that are coming out. That's relatively important. But we have PCE, which is the Fed's favorite gauge of inflation, on Friday. So we're hoping that there's finally some signs that they're going to be a little bit more dovish on this and give us a little bit of relief on the numbers here. But we'll see. PCE is a big part of what the Feds use to gauge what they're going to be doing with the rate hikes. So Friday's a big day for us, guys. We do have a few auctions that are happening Wednesday, we have a short-term 2-year auction on Tuesday. Wednesday, we have another auction. Thursday, we have another auction. Again, auctions are the way the government raises money. They sell bonds so that we have enough money to give it away to other countries. I'm just kidding. I didn't say that out loud, did I? But we are giving a lot of money towards the infrastructure bill. And that's where we get all of the government's money, by selling bonds. So that's what these auctions are for. And they are selling off their balance sheet as well with the loans they currently have that they bought during the COVID cycle. So that's quantitative easing. If you guys remember hearing that, quantitative easing was where they were buying mortgage-backed securities to free up money. Now it's quantitative tightening. They're selling those off. So that's one of the reasons rates are spiking as well. So I want to talk to you guys about assumable loans real fast. These are a magical trick for your buyers. If you just went online, went into the MLS and searched for listings with assumable loans, if you have anyone that's looking to buy a home and they have maybe a little bit of a down payment, or they have a down payment, this doesn't usually work for somebody with no down payment, because a lot of these homes that have assumable loans have had a lot of appreciation. So they have a loan maybe at, like, let's just say this one has a loan at 350. I'm sorry, a purchase price at 350 on a home that has an assumable loan. This loan may be at 250. So that means they would have to bring in the difference if they wanted to assume a $250,000 loan. But let's just pretend this one has a loan of $325,000 on it, okay? I did the number crunching at the bottom. That means they would have to bring in the difference between the assumable loan. $325,000 is the loan they have on this property. They're listing it at $350,000. They would have to bring in the difference of about $25,000 down payment, bridge the difference between the sales price and the loan on the property. If they were to buy this home right now with the same down payment, they would have a rate of 8.25%. That payment, principal and interest, is $24.42. If this buyer assumes this loan, it could be a VA or an FHA loan. This just happens to be a VA loan at 3.125. The payment on the same scenario right now is $1,392. Guys, that is $1,000 difference in payment. That is a massive savings for your buyer. So, assumable loans. This basically means if there's an FHA or a VA loan on the property that is listed, that seller has the ability to offer you the assumability of that loan. So if they have a loan that has a rate of 3.125, you can talk with their lender and you can go through the process to assume that loan and keep the same terms of that mortgage. So in this case, you could go make an offer on that house, offer at $350,000, write in the assumption clause on there with the assumption paperwork that you have in your contract, get the details from the lender, call the lender, and have your buyer get approved to assume that loan, and they will walk away with a rate of 3.125 on that property. So do not miss the opportunity to help your buyers. Now, this doesn't help me at all. I won't get anything out of this. This is for you guys, because if I was a buyer right now, I would want to know more about this. And I would want to search every listing that has an assumption available, because you don't have to be a veteran to assume a VA loan. You don't have to be a first-time home buyer to assume an FHA loan. Anyone can assume a VA or an FHA loan. I want to repeat that. Anyone can assume an FHA or a VA loan as long as you qualify for that mortgage. So do not discount that when you're working with your buyers to find properties.
John,
Yes.
should we be counseling our sellers about that regarding that they can't use their VA?
Yes, that's a
Okay.
very good point. So hold on, let me stop my share screen real fast. So when you, and great point, I think who was that? Was that Debbie?
Yes.
Thank you for bringing that up. So if you're a veteran, and let's just say you have a $250,000 VA loan that you have, and you want to let somebody assume that, you're not going to get that eligibility back when you let somebody else assume that loan. So you're $250,000 of your eligibility will be used up. There is something called a secondary eligibility, where you can still do a VA loan with what's left over of your eligibility, but that portion of the loan that you let somebody else assume will not, your eligibility will not be reinstated for that amount. So if you have a veteran that you're listing the property for, you need to let them know, and we need to dig in, and I can help you with that. We need to see what their future eligibility is without reinstating the eligibility that was used for that initial VA loan that they got. So that is very, very important when you're listing a home. So thank you so much, Debbie, for pulling that out and letting me know that.
And then when they sell, when the person that buys it under that assumption sells it, then the veteran will get their eligibility back.
So let's assume
remember
I just bought that house and the veteran let me buy this house and I held the house for 2 years. And then 2 years down the line, we then sold it. Well, that eligibility, but then it will be reinstated now for that previous veteran once that is all washed up and that VA loan is completely paid off. Very good insight there.
Thank you.
You're very welcome. Any questions on assumable loans? Because they are a huge, guys, if you have kids, here's a ticket. If you have a kid that's looking to buy a house and there's a property out there that's assumable and you want to help them buy it, you can be a non-occupant co-borrower on that to help them qualify and get them into a nice new home as a new buyer and help them purchase their first home. And they don't even have to be able to qualify on their own. They need to have a good credit score, but they don't need to have the income. You can supplement that as a co-borrower on that transaction. So guys, there's a lot of ways to use these assumable loans in this environment. Do not take that out of your quiver, so to speak, of the tools that you have to use when you're working with your buyers or sellers. If you have a listing that has an FHA, make sure they understand the power of that and advertise it accordingly. Any questions, guys? And if you guys have assumable loans, post those on social media. Do they before and after on what that looks like for what the payment would be versus what the payment is on a current assumable loan? Because it is a big eye-opener to a lot of people that don't understand it. There's a lot of people in our industry that don't understand it. So spread the word, make sure they understand what that means as far as payment savings. You can even do a loan comparison, like current payment right here versus if you assume this loan, this is your payment, to really make that shine on your listings.
Yeah, it'd be good to do a squeeze page that would get some buyers into your CRM, and then you can talk to them further and tell them
Absolutely.
you can help us make it look, how it looks.
It's a huge difference. I mean, just that one I went over on the $350,000 home, that's $1,000 savings. And they may not qualify right now, but when you get your pre-qualification and they don't qualify at the point, but they would if the rate was at 3, okay, they now become a buyer at 3. So let's get out there and find an assumable loan for them. It may be difficult, and you may have them as a buyer for longer, but don't discount that opportunity. All right, guys. Well, let's hope that the rates stay steady. Let's hope the PCE, the inflation numbers on Friday, come out tame, which would give us a little bit of a shot in the arm of adrenaline to get us a little bit back on track with mortgage rates. I do think that the Feds are going to go a little bit too aggressive. They always do. and then you will see them cut shortly thereafter. What they're assuming right now is maybe a 6-month, holding it high for about 6 months. That's about the average. So we'll see what happens there. But if you have any questions, stay on the Zoom call. If not, you guys have a wonderful week, and we will be in touch shortly, guys.
Thank you so much, Sean.
My
Thank
pleasure.
you, Sean. Great information.
You're very
Yeah.
welcome.
Thanks, Sean.
Anytime. You guys have a wonderful day.
You too.
Absolutely.